Good afternoon, Professor. We are Group H, and today we want to present you the accounting final assessment, which we split it into three parts. In the case A, me and Oliver will talk about Capital monthly cash budgeting. In case B, Ho will present the Xiaomi premises choice and liabilities analysis. And lastly, Brian talked about the CAPI industry indicators and Xiaomi performance analysis. Starting from the case A and question 1 particularly, we present you the final result of these calculations. You can see that the period is split into 12 months from July 2021 to June 2022. The beginning cash is $5,000. The ending cash is $18,700. The low months present the low performance, the losses. That's why the cash is dropping, and we can see the cash shortage. But at the end, the higher performance months are doing much better. That's why the cash is positive. But let's split the calculations. Firstly, revenue. It consists of revenue from ZIT meetings and revenue from sales of goods. In general, we'll calculate the small parts. For instance, from revenue meetings, it depends on meetings per month, number of people, and average revenue per customer, while the revenue of sales on goods depends on the every unit's number of customers multiplied by the share of people consuming this product and the price per unit. As for the cost of goods sold, which we assume to be the variable costs, it consists of ZIT meetings cost, the EasyCard commission, which is half of the revenue multiplied by 1.5%, not inventory managed goods cost, labor cost, and inventory managed goods cost, soft drinks and ice cream. The most important thing is that we don't include can of soft drink and ice cream into the non-inventory management. They included into the inventory managed goods because you need to buy the packs for them. As for the fixed costs, which are operating ones, we include different components. The most interesting part is that we assume that the next insurance period will be paid in June 2022. That means that company will still continue its operation with the 2% inflation increase, which we took from case B, by the way. Since the communication expenses must be paid a month in advance, the June 2021 is the sunk cost, $40. At the same time, in June 2022, we pay 2% more because we adjusted to inflation as well. Thirdly, the 30% of the owner's property rate should be paid by the company. That means 1,200 multiplied by 30% in November 2021, as you can see in local authority charges. And last but not least, the administration fees are paid 1 month later. That's why in July 2021, we consider the cost on this part is zero. Lastly, the profit and cash inflows. We calculated the profits with deducted tax, but we haven't calculated the cash. We need to take into consideration the drawing by the owner, since the owner wants to take 1,000 every month. The depreciation rate, put it back, which is to $175, and also minus $9,000 of kitchen equipment purchases in July 2021. Last but not least, owner receives a salary. It is tax deducted, but she doesn't take the salary. That's why we should put it back into the cash balance. As a result, we can see minus 7.8 thousand during the first month. But at the same time, since the high seasons months are more profitable, the cash balance is growing till 18.7 thousand. So which conclusions we can say? Actually, company has a real issues. Firstly, it has the real cash shortage for the first 6 months. Since most of the obligations are short-term, I mean, you need to pay electricity every month, it's a real problem. That's why we would recommend to find other financial sources for this company to survive the first 6 months. At the same time, even though it's unprofitable during the first 6 months, during the first 5 months, it's still potentially beneficial because high months produce much more revenue. That's why we have the large cash in the end. Last but not least, we can also give some recommendations on the budgeting and financial obligation covering. For instance, we can buy inventory during the high seasons, and we can buy the equipment during the high season as well to avoid the cash shortage.
Okay, so the question 4 is calculate the break-even number of customer. So first we got the number of the customer every year. Then we consider the variable cost as cost of goods sold and the fixed cost as operating expenses. Then we can get our contribution margin, which is revenue minus variable cost and divide revenue. Then we can get our answer, which is fixed cost divided contribution margin. And next is question 5. Calculate the customer average number if EBIT are 20,000. So first we have to add our depreciation back to the calculations. Then we calculate it as what we do in the question 4. On the right side of the equation becomes 20,275. So now the new formula will become 20,275 at fixed cost and divide contribution margin. And now we can get the customer number we needed, and we can get our average number of customer.
Moving to question 7, it was asked how the revenue and profit will change if we put the marketing cost during the low seasons of $50, but it will increase our customers by 25 per hour per day. So like to compute the profit, like you can see it's on the table below. We can see the revenue increase by 41-32% depends on the month. At the same time, the profit actually losses have dropped by 22-37% depending on the month and amount of operational costs, which actually resulted in the increase in final cash, which is $25,900. As for some potential strategies, we would recommend to do marketing during the high seasons as well, and reconsider the inventories purchase plan. For instance, in the table below, you can see how the situation will change if we pay $50 during the high seasons as well, with the increase by 25 customers assumed. So we can see the rise in the revenue by 10% and increase by 21-33% in profit, which is really good. As for the inventory purchase plan, in the first table, you can see the initial inventory plan and our inventory plan. What we want to do is just take the purchases and put them in the high period to reduce the cash shortages. As a result, you can see that the cash shortage in low seasons have decreased up to 2%, like in October, which can be considerable like in scale. The cash in the end of the whole period also increased by 0.53%, which is quite a nice cashback.
Okay, so let's move to the last question. Suggest some challenges they might face. So the first will be the seasonal challenges. Since they have already experienced the high season, they will soon face the low season, which is from November to April. And the company should be possible to avoid the emergencies during this period. And the next challenges will be the market competition. So like Donggang is a famous sightseeing spot. Once one coffee shop is successful, there will be many similar stores to open there. And there are some possible solutions. So first is price changes. The store can choose to increase its price during this period. Then will be the inventory reduction. The inventory can be purchased during the peak seasons to decrease the cash shortages. And next will be a full-year marketing campaign. The marketing during the whole year can increase the profitability rate as well as to ensure the restaurant's competitive advantages. And that is the end of the part A.
Okay, starting for case B, the first question is requiring us to do a comparison between renting options. And the table provided is a summary of costs for both options. And by analyzing the components separately, the option 1 and option 2 have equal number of advantages, while option 1 is located at a higher end shopping center compared to option 2 and has lower cost of insurance, working capital, and does not need to spend money on equipment. Option 2 provides longer term of lease as the company wants to establish itself in this region. This can be useful. Cheaper rent and management and promotion costs and possibility to sell the equipment in the end of the period. And question 2 is to choose between option 1 and option 2 for Xiaomi. And the two tables are detailed costs of each year. We assume that all costs will increase annually by the inflation rate, and net working capital would be received back at the end of the renting period. And the equipment in option 2 will be sold in the end of the renting period, which is year 5. Based on the calculation, option 2 seems to be more preferable since its average annual costs are lower by $2,190 than option 1. As for question 3, we are required to do a comparison of liability components. And in terms of short, long term, since the maturity date of the liability components is unknown, they could all be considered as long-term liabilities if the maturity period is longer than 1 year. However, each of the liability types has the short-term components interest rate that must be repaid within the year. Net working capital depends on the current assets and current liability amount. If we assume that all the liabilities are long-term, they do not affect it directly. However, each liability has interest rates that can affect net working capital. The larger the interest rate, higher the compounding frequency, the more it would affect the net working capital. We should definitely consider an unsecured loan as the liability that's affecting net working capital the most for its high interest rate and high compounding frequency. Companies should take this into consideration since daily compounding rate can make it more complicated to repay this loan in the future. Bonds would be the second liability that would affect net working capital the most since coupon is paid twice per year and the amount of this liability is much higher comparing to others. Secured loans would be the least affecting to net working capital since its interest rate is the lowest one. However, this loan is more than 3 times larger than unsecured loan, which is around 17.6 million. Furthermore, if the company fails to meet the obligation by this loan, the company can lose its collateral. Since collateral is usually long-term assets like land, property, it won't affect net working capital directly.
Case C, question 1. There are some potential risks and benefits of receiving share. First, the liquidity can be limited. If the stakeholder wants to turn the share into cash, the time depends on the number of sellers and buyers in the market. Second, the value is easily affected by the stock market. The stakeholder has to bear the fluctuations of market value. In addition, if the company faces financial difficulties, legal issues, or other challenges, the value of the shares may be affected as well. In short, receiving share will provide opportunity for long-term growth, but will also expose the stakeholders to the risk of limited liquidity and uncertainties of market value. Question 2. In general, this industry performs quite okay, but there are some concerns. The earning quality score is 44 out of 100, suggesting that the earnings of this industry may not be stable. The gross margin is about 30%. We can know that this industry earns quite a lot of money by selling their products. For the liquidity, the number of quick ratio is 0.75. Above 1 is generally considered favorable, so we may assume that this industry may have some issues when facing short-term liabilities. On the other hand, the current ratio is 1.45. Quite good. It means that this industry has sufficient asset to meet the short-term obligations. The high value of leverage is quite concerning. In general, companies will like to keep this below 2, but as you can see, 2.48 means that this industry may be quite in debt. The other thing is that the average inventory days is 70.1 days. In our opinion, it is too long for a coffee industry. It is possible that a cake will take up to 70 days to be sold, which is quite weird and unbelievable. In conclusion, this industry performance is ordinary, earning a moderate level of profit. But the obstacles for growth may be the higher proportion of debt, the issue of meeting short-term liabilities, and a long period of inventories. Question number 3. Since there are no numbers of revenues in the sheet, we use the equity number from case B to calculate revenues. So we calculate the net income with ROE, and with the net margin we get results of total revenue. And finally, the average revenue growth rate, 3.67%. Question number 4, we simply calculate the average of net margin, which is 7.18%. Question number 5, considering the performance of Xiaomi Company, we believe that Ms. Shi should receive share instead of cash. To evaluate whether Xiaomi Company is earning profit for the shareholders, we can take a look at the ROE. As we can see in the table, the ROE has been increasing, but there are some factors that may cause high numbers on ROE. The first one is using financial leverage, like borrowing a lot of money to finance the operations, and because of the formula, the increased number in debt does not reflect on ROE. The second is that the profit brought by extraordinary items which are irrelevant to operating activities like selling out the company's assets. However, in Xiaomi's case, the ROIC has been increasing as well. Because ROIC deducts current liabilities and consider only the capital invested in long-term operations, it eliminates the impact of short-term liabilities. Similarly, the numerator excludes the effect of non-operating items, so according to the numbers of ROE and ROIC, we may conclude that in these 5 years, Xiaomi Company had been continually earning profit for their shareholders, so she should have received share instead of cash. And this is the end of our presentation. Thank you, Mr. Martin, for your time, and wish you have a nice summer vacation.